Good afternoon, everybody. This is David Hadley from Bulletproof Legacy Financial. We're going to talk about 10 reasons as to how annuities can actually outperform bonds and some reasons you may want to consider annuities over bonds for retirement purposes. Now, number one, first and foremost, is that annuities can actually perform a guaranteed income stream for the rest of your life. Bonds are contractual. There's so many different types of bonds too. There's junk bonds, corporate bonds, long-term bonds, short-term bonds, treasury bonds. How do you know which ones to get? There's so many different types of bonds out there. Interest rates fluctuate all the time. You're having to constantly renew them like a CD at the bank almost. So you're constantly having to follow up on it. There's no guarantee of a lifetime income stream on there first and foremost. Another point that we really like to bring up is that there's higher payouts in low interest rate environments with annuities. Bonds, the rates of return are going to go up and they're going to go down. And again, it's totally contingent on long-term, short-term, which type of bonds you're in. Are they going to mature? Are they going to mature early? It decrease the probability of you actually getting what you thought you were going to get out of the bond, whereas the annuity is an actual contract for that whole time, whether it's 7 years, 10 years, 14 years, if you will. There's even guaranteed income stream riders that you can attach on there. So annuities are going to give you a much more certainty, especially in lower interest rate times. Another thing to really consider is the tax-deferred growth with the annuities. Now, earnings in annuities, they do grow tax-deferred, while bonds interest is typically taxed annually, which can erode returns over time. See, if you're paying your tax on there year after year after year, and you're not taking advantage of the ability to leverage compound interest and pay the tax when you're actually taking the money out of there, you're eroding your opportunity at compound interest right there. So that may be another great reason to consider annuities over bonds in retirement or for the security portion of your portfolio. Another thing to take into consideration, reason 4 is the mortality credits. Annuities, they actually offer mortality credits. And there's extra returns from risk pooling effect among annuitants, which doesn't exist with bonds. Enhancing long-term income potential as well. So the fact that you can actually get these mortality credits on there is another little bonus with annuities, which you're not going to get any mortality credits on your bonds. It has nothing to do with the longevity of your life or how long you're possibly going to live. So another great reason to use annuities as opposed to bonds in retirement. Another reason to consider annuities in retirement is that there's no reinvestment risk. Many annuities, they actually offer principal protection and guaranteed returns, shielding retirees from bond market downturns or rising interest rates that devalue fixed income holdings. So the fact that the market's going to go up and down with these bonds over time, as the market volatility increases, maybe the bond returns are going to actually lower. Whereas you can have a fixed interest rate in the annuities at any point in time that may be higher than what you're going to get in terms of the bonds anyways. So another great reason to consider annuities over bonds in there. Next is the customization and options that you actually get with annuities. You can ladder them in all types of ways, but annuities can be tailored with riders, inflation protection on there. That's another thing to consider too, like inflation protection. You may start with a little bit lower amount, but the payout on the annuity, you can have it increase 2 to 3% every single year along with inflation. So it starts a little bit lower and it'll increase with inflation as time goes by. Or you can start with a higher payment, but it's going to stay level the rest of your life after that. So the fact that you can actually choose something that's going to increase with inflation over time is another huge benefit with annuities, and why I recommend to so many of our clients to consider an annuity as a bond alternative because of that flexibility it's giving you to keep up and trail inflation if that's one of your concerns. Another thing is just it's simplified retirement planning. You're not having to revisit this every single year and restructure all your bonds. Now, it is recommended that we do a portfolio review. We check if you want to reallocate to a cap strategy, spread strategy, a participation rate strategy, or even the fixed interest strategy, depending on what the rate is. Everyone has their own preference. But by converting a lump sum into a predictable income, annuities can reduce the complexity of managing a bond ladder or a sequence of withdrawals. You might as well sign up and go be a financial advisor if you're going to be in there managing your bond portfolio every 3, 6, 12 months, or depending on how long you're renewing these bonds for. It's a much simpler approach, straightforward, and a little better protection and insurance, if you will, by considering the right type of annuity for retirement as opposed to the bonds. Another thing to consider when using annuities versus bonds is the behavioral change and the behavioral advantage. Now, receiving regular annuity payments can help retirees avoid emotional and potential harmful decisions like panic selling, which can happen with bond funds in down markets. God forbid you start worrying and panicking about everything and you go push in the chips on your bonds prematurely, or they're making your bond actually come to a halt much earlier and you're not getting able to ride out that full 5 years, 10 years, 20 years that they got on there, and it stops, or you're having to panic sell because you're worried about the market. See, the annuity is going to give you that cushion you need and make sure that you have the downside protection in there as well. God forbid the market ever goes flat or negative. With the right type of annuity, you can avoid this entirely. Another thing to consider is the longevity risk hedge. Annuities uniquely address longevity risk, ensuring that income continues even in retirement, whereas bond portfolios eventually run out. Imagine having to find yourself in your 70s or 80s or even 90s, and now your bonds are maturing on here, and you got to go revisit this. Do you have the mental capacity to do this? Do you have the bandwidth to go and do this? Do you even want to go and do this? See, this all could have been solved entirely by having the right type of annuity. You guys, a few annuities that we're actually recommending that you can do this with is one is a flexible premium annuity for the younger folks that want to regularly add to their annuity over time and still have that downside protection in there. Maybe the cap is like 9%, you guys. You can get up to 9 or 10% of all upside of the market, but have that downside protection in there. Perhaps you want to go with a single premium indexed annuity or a SPIA and just put that one-time lump sum in there, leave it alone, and let it grow. You can still index the market and you can still take a fixed rate. Great bond alternatives with that downside protection in there, but you get the benefits of a contract of knowing that it can actually drag out for 3, 5, 7, 10, or even 14 years in some states. These benefits, you guys, are imperative to have in retirement. You're not worried about last-minute stress sales or decisions on making a good investment for your portfolio. So another thing to consider is the MYGAs, multi-year guaranteed annuities. Rates right now are better than you're usually going to get in any CD at the bank. It actually defers all taxation until you take out the money. There's even options where you could just withdraw the interest on an annual basis. Also, knowing that if the market goes up 20% or it goes down 20%, that you're going to have that fixed rate that surpasses what most bonds and CDs will even give you at the bank. Also deferring those taxes and giving you the peace of mind that you're going to have it coming in for that entire contract, 3, 5, 7, 10, 14 years, depending on what you go with. The last option and one of the best alternatives to an income stream is that immediate income generating annuity. See, there's some annuities that have these riders built into there. Be careful of paying about fees for things you're not using, like income riders. I've seen many clients be paying a 1.15 or 1.25% every year for an income rider, but they're not using it for 5, 7, 10 years. This can really erode your ability for compound interest. But knowing that you could turn on this immediate income stream any point in time and next month for the rest of your life, receive a paycheck the rest of your life coming in. It doesn't matter if you live another 1 year or you live another 30 or 40 years. A lot of these annuities, they'll pay until 110 years old. How many bonds do you see out there that are willing to go that far out and give you that type of insurance on the income that you're actually needing in retirement? You guys, I hope these 10 reasons were very informative to you and helping you understand how you're going to make your decision when it comes to considering annuities versus bonds in retirement. Again, my name's David Hadley with Bulletproof Legacy Financial, and I look forward to helping you bulletproof your portfolio.